There we go. All right. So Chuck says, good afternoon, Mike. Good afternoon, Chuck. It's great to see you here. Chuck, of course, is down there out in New Zealand. Sam comments in, good afternoon to all. He was selling calls, which was a good this week. Had some collar trades, nice run in ZM, Etsy, and Snowflake, Tesla, Apple puts, and selling the 16th spread on Apple expired at 0 today. He also mentions ENPH and RAGI plus APPS was also adding gains today as well. That sale position I was looking at was up today when the rest of the market was down. So it was pretty interesting there also. All right, so let's begin. First question is Williams. Second question, I believe, is Octavio. And the third question is Lloyd. So William asked a question. We've reviewed this recently regarding the market sentiment tool. William says, can you show us how you use the market sentiment indicator readings to decide when to allocate more capital or take more capital off? First off, I'm just going to be very clear, William. Even with the married put positions and even with the bull put credit spreads, I don't typically put in more money or take money out. All right, I've set my beginning structure of the position to start. It's just the way that I trade. So, maybe 3 or 4 different strategies going in my portfolio at a time with maybe, 6 to 7 trades in each, depending, in each strategy, excuse me. So in any case, I don't tend to add or take capital off. When I open a position, that's pretty much all I'm going to do, and I'm just going to manage it with options in different places. But yes, I'll still address that. And then you also said specifically, would you add a new married put positions when the MSI is at a certain level, i.e. bullish? Yes, I would. And would you take off married put positions when the market sentiment indicator is at a certain level, bearish? Not necessarily, William, but we'll talk about that as well. Okay, so what we're talking about here is the market sentiment tool. It is one of the available pods here on PowerOptions. And right now we see we're in a neutral position. We've got 2 of the 13 indicators are bearish. 9 are neutral, my apologies, and 2 are bullish. To see the more details, I'll click the View Indicator Details button, and we can see the description or brief review of the 13 different indicators that are used. The VIX is actually entered into a bullish range right now, it looks like, as has the SPX MACD gap. Bearish is the number of days the SPX has been over its SMA 100, and the put call volume ratio has actually slipped into bearish. That's across the entire market. That's pretty interesting. But to answer William's questions more, let's go into the view overall sentiment history. So this shows me a history here of the different signals. The most recent one, of course, was back here in 826. Now, we were seeing sell warnings leading up to that. And on 8.5, we were seeing bearish sell positions. And it did go up and then pull back down, but then it continued up and we started seeing the strong bearish sell again. Not the highest. This isn't the highest warning, but we did go to the strong bearish sell again before the market sort of began a little sell-off here. And now we're just kind of meandering about, but we're still pretty low compared to where we have been, just related to SPX. Why am I highlighting this section? Well, because, William, at this point, the consideration I was doing is once the bull put credit spreads I had open at this point were hitting expiration, some of them got a little bit close, but I wanted to wait until I saw that easing when we got up to 35 weight. I wanted to see till we got that easing before I entered new bull put credit spreads. I think I missed a cycle. I missed about a week, not a full 2-week cycle of bull put spreads, William, but I missed a week. I didn't do it when you first start seeing the sell warnings. It's usually when I start seeing these 3 bearish sells in a row that I know that we're coming to a point where likely we're going to see a little bit of easing. Got to turn the valves and release the steam on the market, so to speak. And that's exactly what happened, sort of a 200-point move down. Oh, maybe not quite 200, but we saw that dip down recently and a little bit of easing. Oh, sorry, I think it was 3 to 4 days there that came through. Hold on one second, folks. Let me just take care of this, okay? So, I apologize there. All right, excellent, sorry. So that's when I'll look to do certain things. And let me try to get the pen back over here. When this started happening, we got a lot of questions naturally from subscribers of what should I do now? Well, you kind of know what's in my portfolio. I'll have married put positions. I'll have bull put credit spreads. maybe a couple diagonal spreads, calendar call or calendar put. Calendar, I'll just put calendar, okay? And may even have some long calls or long puts in the market, and then some VIX calls. Might even have some standard collars open. Okay, so when I started to see this, was I taking money out of the married puts, selling some shares, selling some puts? No. Looking at where the positions were, if they weren't bulletproof, William, I'd consider adding an extra put to create sort of that synthetic straddle or synthetic strangle, depending on the costs that were available. I didn't this time around, but the last time when we saw the bearish sell in February, I ended up buying, I had some puts that were out to January, I had some puts that were out to October. I ended up buying more cheaper March and April puts on some of the married puts, an extra put on 2 of the positions to go with that synthetic straddle or strangle. If my bull puts, when I start to see these sell warnings, are only a few days to expiration, and I'm still far enough out of the money that I feel comfortable, I may not make any adjustments. If the market had been declining to this point and the bearish sells triggered then, and the stocks were near, let's say, 2%, 2.5%, maybe 3% of my short bull put strike price, I may consider closing out the bull put if it's profitable at that point, rather than risk seeing a 10, 20, 30% loss of the maximum I could take. So I would scale down, in a sense, the bull put credit spreads. This case I didn't. I waited to expiration. One got really close. The other 3 I had open, I believe, expired worthless. Although they expired worthless. I think I don't remember if it was 2 or 3 in that cycle when the decline happened. But I did take about a week off until we went back to neutral to start entering the bull put credit spreads again. Now, I'm going to see how far back I can. Oh, and the calendar spreads, what I typically do in this situation, if I see the bearish sell, is I'll leave the calendar spread as it is. Because if it pulls back, hey, that short call is just going to be better in my favor, William. And then what I'll do is I might add a shorter term put to, once again, like the married put, create that synthetic straddle or strangle if I'm anticipating a pullback. All right, so that's how I use this on the bearish side. I usually look for 3 of these, 2 or 3, maybe 4 of those bearish sells in a row. And that's when I really start to think something's happening and I may want to start doing some adjustments. For those of you who might be in covered calls, if you're fearing a downturn because the bearish sell come up, or you're in a cash secured naked put, you might also want to add a put to protect the gains that you have, or if you've reached your profit target, just buy to close the naked put or close out of the covered call if you're concerned about the downturn coming up when this goes to a bearish sell warning. Now, I don't know if I can go back that far, William, here on our webinar trial account. So what I can do here is I'm going to scroll back down through the history. You can see here where the last sort of green big bulls, big bullish warnings took over, William, on this chart. And that was, of course, right after the March decline. So I can go back to 918. So, oh, sorry, that's today. I went the wrong direction. Let's go back here. Yeah, that's what I wanted. See how far back I can go. Oh, wait. Oh, Greg has the whole history here. Okay, I'm sorry. That's a change there. I apologize. I can go back as far as I went. I don't want to go back to 2017. Why am I here? Sorry, folks. It should have only allowed me to go back a certain amount of time. Let's go to July 20th. I apologize for that. And let's roll this again here, okay? All right. So I'm going to go back, just scrolling back, almost so close. There it is. There it is. Okay. Here you go. Right around this time, William, 325, 320, 318. Hey, St. Patrick's Day, right around 317. That's when we started to see the very bullish buys, when the SP was jumping around. Remember that we were seeing those 200 or 300 point days, but we were down to 2398 after that big February decline. If you remember, it was around this time, March 20th or so, where we posted that first webinar of current market conditions and what should you do now. Around March 20th, this is when Ernie started picking up, March 20th, March 23rd, he started picking up January calls at the time, so coming up to January expiration, on bigger stocks that he knew would come back. So he was buying January calls slightly out of the money on things like, I believe, Apple, Bank of America, JP Morgan, maybe Citi. I'm trying to think. I think he did Facebook as well. I decided that looking at this, I was thinking at the time, which stocks or which companies, this was right after the first lockdowns and everything, and this was near the bottom, we started to see those very bullish buys. What did I do at this point? I opened a Marriott put on KHC. I bought calls on Costco, on Clorox, on Gilead, things that I was thinking were going to be benefit, lack of a better term, from what was going on. Ernie also did Home Depot during this time frame as well. Would have been a good time, of course, to open standard collars if you just wanted a quick return, but we're worried still about the volatility in the market. It could have been a good time for covered calls as well. I personally, because the market was still fraught with volatility, which was very profitable, I didn't actually start entering bull puts again until April 6th, April 7th, somewhere in that. I think it was April 6th, as a matter of fact, is when I started doing the bull put credit spreads again. I waited during this time because volatility was still high, and you can see there was jumps here, but there was a 200-point jump over a 2-day period after we started seeing the first very bullish buys. Okay, did I add more money into my Marriott put positions at this time, William, that were already open because we had hit the bottom? No. Once we hit the bottom on 320 for the Marriott put position, still puts that were out to October. I think I had one out in December and then a couple out in January, such as the Kraft one I mentioned, which was opened a little bit later. But this was the time to use the income methods that are talked about in the blueprint. I could roll the put down to average down the cost basis when I thought we were at the bottom. So instead of putting more money into the position to average down, I'm using that second asset, the put, to completely lower my cost basis. Not completely to zero, but you understand what I mean. Rather than put more money in, I'm taking that second asset, lower the cost basis of the position, and be in a better position to take advantage of the recovery. Should have done it with ON Semiconductors, but I didn't, and that thing still just waffled about even during the big gains as well. Likewise, sorry for scrolling, folks, but likewise with Ernie was a little bit more comfortable at this time, just starting the bullish buys and looking out for stocks that he feel would rebound. I waited a little bit longer, but same as we just talked about with the bearish sell warnings, I'm going to wait for 3 or 4 in a row of the very bullish buys. That's when you typically see near the bottom, and then you start to see the recovery in that case. And so that's when I would start doing those positions. Okay. If you had started in February planning on a market decline, okay, so let's go back. And it was mostly neutral until this time because it wasn't really, the market was getting overbought. But what had ended up happening is that the sell warnings were around January. Okay. And I did prepare for the portfolio, as we talked about. I did some VIX calls at that time. I didn't do UVXY. I did that later when the volatility was too high to buy VIX calls, still concerned about the market decline. This is in March and April, and May and June, for the matter of fact. But in that case, when I got into those VIX calls and the market started turning, when I see the very bullish buy, that's when I want to get out of them. Okay, so if I had been planning for the downturn, I bought puts on SPY or I had done that, what do you want to do? You want to try to maximize the return. Now, I have a different way of approaching the VIX calls. So when it got to, let's say, 100% return, I'd sell half, then another 100%, I'd sell another half in that case. I left a couple open here because it was accelerating beyond 100% return. The rest of the portfolio is getting hurt that I hadn't closed yet. But in that case, this is what you see what was happening. Okay, so again, look for maybe 3 or 4 in a row, William. And that's when you would want to look to do that. With a very, very bullish buy, look to enter the bullish positions depending on the severity. This was a huge severity of a downturn, of course. So things were extremely depressed. So the idea of buying those long calls further out in time was a good approach that Ernie used. And I sort of followed his lead and did different stocks. And they kind of all worked out well. May have closed them too early, but that's okay. Went into other positions later on. And then when we see the current very bearish, there we go. Those very bearish sell warnings, 3 in a row. I'm not necessarily pulling money out, but I'm going to stop strategies at a certain time, such as the bull puts. I might take a break until I see it go back to neutral. I might make that adjustment to the calendar spreads I mentioned. I do make recommendations to customers that are in covered calls and naked puts when they call up. that you may want to consider adding the put to protect some of the gains you might have in that stock or that covered call position. Or if you're at your or near even your profit target, then go ahead and close out of the position. Okay. All right. So while we're here, I got to do something real quick. Frank, I wasn't ignoring your questions, but I just wanted to go through. Frank simply said, can you please tell me how we changed the horizontal slide? Because I'm dragging something. I feel like I'm dragging something wrong. Okay. What Frank's talking about here is on this view. Oh, let me clear out the drawings. On this view here, this little scrubber down here allows you to make this more isolated. Okay. So I just clicked. Here's what I do. I clicked on one spot on the graph, Frank, and held it, left click, and then I just drag. Okay. So I'm just going to click here, and let's just go back to that time frame. There we go, where we started seeing those bearish sells here. Those are the 3 or 4 in a row of the very bearish sells we saw back on 823 and 830, 825 in those time frames. Okay. Now let's can I click out of this? Let me wipe that out. Just a simple what's called a scrubber. So if I wanted to even highlight over here and just click it, and I'm just clicking in this zone for 2018. Okay, and we can go into the green section there. We started seeing it on December 1st of 2018. Remember, that was after that huge rundown of October and then into November. Okay. All right. So it's just any time frame that you want, just slide it over, and then you can slide it back and forth as well. Now, in relation to your other question, you had said, how are you doing that? This is probably different. It's set up so we can show most things on this webinar account, but it looks like a free trial. I don't know why yours doesn't do that, Frank. It should be doing it for everybody in that case. Now, when I went back to 2017, when I scrolled this down here, I think it's because the programmers had turned this on for me as an administrator. So I can go back further than just the regular 3 months if you're just on a trial or just on the standard view in this case. I think that's what happened, but I'll have to check and make sure on that. I remember when I logged onto your account, Frank, it was working fine. When I logged onto your account when we talked earlier, not today, but previously this week, I believe it was Monday, excuse me. When I was logged on as you to look at those portfolio positions, I did it there on your account and it worked fine. Let me know, you don't have to do it now, but let me know later. Okay, you're locked between 9.8 and 9.18. It might be something set in your browser. Let me know later what browser that you're using, and I'll have to take a look at this tool on that browser to make sure it's functioning properly and profitably.